everybody. Welcome to another episode of Stock Talk. This is a little podcast slash video that I like to put together once a week where I like to talk about all things investing, talk about what's going on in the market, some of the observations other people are seeing in the market, sharing it with you, and sharing my own personal observations about what's going on in the market, and also sharing how I'm going about making investment decisions in different market conditions, hopefully with the goal really that you can take some of the knowledge and some of the stuff that I'm kind of facing and dealing with and thinking about, and hopefully maybe bring it back to the type of investment decisions that you're facing. My name is Amin Reina, and I'm an investment coach and founder of Sage Investors. And as an investment coach, what I do is I help people who want to become more financially independent, but feel totally confused, frustrated, intimidated by the whole investing concept, the whole concept of investing in stocks and bonds, ETFs. They either don't know where to start if they're just starting out investing, or if they've been investing for a long time, they just are kind of frustrated and with the lack of progress that their portfolios are making. So what I do as an investment coach is I teach people, I engage with them on how to make more educated and more successful investment decisions so that they can increase their chances of achieving financial freedom in their lives and achieving it with confidence. So this is episode 93, and today I want to talk to you about, I think, sort of one of the wild cards of investing that really separates really good run-of-the-mill investors with people who really make good investment, long-term successful investment decisions, and they can make them more consistently. And the cool thing about it is it's not, this particular trade I'm going to talk about is really hard to find in the financial services industry. It's more conducive to people like you and me who are just kind of outside maybe the industry, but are, actively engaged in growing, want to grow their savings and want to invest. And so it really comes down to this trait that I'm talking about. It really comes down to the concept of perspective and context. And I really bring it into, when I say perspective and context, it's in the context of the numbers. One of the most common things that I get when I work with people who want to get into investing, and what really freaks them out and scares them about investing, and I've said this over and over again, I'm a broken record on this, is people are really scared of the numbers, the math. It really overwhelms people. And people feel that if they want to get into investing, if they want to do well in investing, they have to have this incredible math degree and have to have this incredible knowledge of all different kinds of financial ratios and be proficient with using Microsoft Excel. And you're just kind of like a quant jockey. And you know what? It's pretty easy to want to fall into that kind of belief because we're such an analytics-driven society now. We're such an information, data-driven society. And technology has just enabled us to just process ridiculous amounts of information and create information, all with the goal to help us make better decisions, be it investing or whatever. Other kind of business relations. We have investing, we have high-speed, trading now. We have people out there like physicists and computer scientists generating, developing algorithms that can process and actually, capture or take advantage of certain market conditions and do it within milliseconds, and dubiously even do it before people like you and me can figure it out and want to do something and make a decision on our own. And they can do it without really, you can program it, you can code it, you can put it on a spreadsheet, you can run algorithms on it. But what you can do is you can't provide perspective. It's sort of like, if this, then do this. But a lot of times you need perspective and you need context. And that's really one of the limitations, I think, of current way we make decisions in terms of analytics that we drive in our society now. Now, it might make me a little bit more old school, but I guess, yeah, maybe I'm old school when it comes to this. But the interesting thing is there's so much information we can generate now. There's so much data out there, so much investment data that we can act upon and make investment decisions. But a lot of times we're paralyzed in making decisions. We suffer now a lot more cases of analysis paralysis. And I'm kind of noticing a lot of that, and the reason why we can't make decisions, and I'm going to talk about some examples where I'm seeing this, where we can't make these decisions is because we don't have perspective now. We don't have context. We've lost a kind of an attachment an attachment to the value of money. We look at it as just numbers now on a screen, on a phone. Numbers, the analysts kind of just throw around billions now, trillions. It's just, we think about it, we just look at it, but we really don't understand. We've lost that tangible meaning to it. And so that's really what I want to talk about it, is that, and the cool thing is, as investors, as retail investors, individual investors like you and me, we have that ability to still attach ourselves to perspective. We can use perspective, and we can use perspective and context for our own personal advantage, because unfortunately the people who are filling us with this information, which is usually Bay Street, Wall Street, mass media, mainstream media, they don't have perspective and they don't have context, because there's certain constraints that those sectors, those stakeholders operate under. But you and me, we don't operate under those things, and unfortunately they're not going to give us perspective and they're not going to give us context. So it's up to us to figure it out. And the cool thing is, it's not that bad. It's not that hard to do. So I want to talk about a couple of areas where I'm seeing this sort of lack of perspective and this sort of emphasis so much on the numbers and data are kind of almost hindering people from really opening their eyes to see really cool investment opportunities that are just sitting in front of them. So the first area where I noticed this kind of lack of perspective and sort of almost this analysis paralysis kind of thing is really what's going on with the central banks. The first, literally, since the financial crisis in 2008, 2009, central banks basically dropped interest rates to practically nothing, with the whole goal to stimulate economic activity, put some more liquidity into the financial system so people could start investing in ideas, products, services, and bring the economy back up. Get people working, get people more employment, get businesses to be more profitable and productive. And the thing is, it kind of worked in the sense that unemployment, if you look at the numbers since 10 years ago, unemployment is there's more jobs being created now than in 2008. The economy is growing, both in the US, globally. It may not be gangbusters like in the US, but it's growing. It's going in the right direction. People are working. There's more people working now than there were 10 years ago when all this stuff happened, when they dropped interest rates. Normally, traditionally, when economies recover and start getting traction, that's usually when central banks will basically start increasing interest rates. But we haven't seen it. And the usual fallback position, that reason why we haven't seen it, and it's constant, is this concept of data dependency. You'll hear this as a reason. We need to see more data. We are heavily data dependent and we will make decisions based on it. We're in a world now where these institutions want to see some kind of 100% validation of a specific economic activity or economic behavior before they make an action. And it's literally up until just a year ago that the Federal Reserve, and I'm using them as the example because they're the ones that keep citing this data dependency. We need more data, we need more data. It took them like 9 years, and a lot of growth and a recovery has been well in place, but they haven't increased interest rates. They're just worried about something. There's clouds on there's always clouds on the horizon. There's just that decisiveness is not there. And a lot of times the fallback position of why active decisions don't get made is numbers. There's not a number. And it's ironic because we have so much data now. There's so much information in real time, literally, that we can make decisions, but they can't make it. They're looking for some of this perfect piece of interest. And it's the reason why I talk about it is and I'm dating myself in terms of how old I am, but in the late 70s, early 80s, we had an inflation problem around the world. There was a lot of excess inflation. And the central banks, and the Bank of Canada here and the Central Federal Reserve in the States, they made a decision to say, you know what, inflation is too high. We need to increase interest rates and increase interest rates aggressively, or else we're going to have a real problem. And the problem is doing that is it could stimulate a recession, it could have a negative impact on stock prices, a lot of bad things come out of it, but they did it. And at one point, interest rates, the prime rates, and whatever you want to call it, whatever you want to measure it, we're almost near 20%. Imagine 20% interest rates. And here's the thing, when I think about this, I'm going, I don't think they had a lot of information. The amount of information that was probably available at that time to make that kind of aggressive decision probably wasn't there compared to what it is now. Yet they were able to use judgment and really understand the fact that, you know what, we don't have complete information. We're just going to have to use sound judgment, sound basic economic principles, and do it. And they did it. And it was a very difficult decision, and they did it. And I tell you, when we look back in history now, that was probably one of the hardest decisions that was ever made, and it was probably one of the best decisions ever made because it really controlled inflation. Inflation since then has been next to nothing. It's been well contained. We haven't had those crazy hyper increases in inflation like we did in the 70s. And so a lot of it was just judgment. And it's amazing to see that in that period they didn't have a lot of information, but they were much more confident and sure. But here now we live in a time where we have so much information and you can't do anything. You're stuck. Well, it's only now that interest rates are going, but even now they're like so scared to increase rates because they're just worried about like just what nuance, what a quarter point hike is going to just throw the whole world economy and the whole financial system in chaos. And it's clearly not, because the banks around the world are much more capitalized to deal with a pressure than they were, but they just don't want to do it. So I have a hell of a lot more admiration for the Paul Volckers and the Gerald Buoys at the time who made those calls. Those were incredibly difficult decisions back in the late 70s. And they were not popular, but they did it. And, you know, they did it. They took an action. They made it. And that's a lot of times what investment decisions are, is using judgment to make decisions based on not complete information, not perfect information. And sometimes you just gotta make a call. And I think it's a perspective and it's a context that's clearly lacking now, and it's ironic. So that's one example. A couple more examples I want to give you, and this relates to really the context of perspective as it relates to numbers and understanding the value of money. And it's just the way Wall Street, Bay Street behave, the analyst side of the world behave with respect to how they evaluate performance of stocks and of companies out there. So the best example, to me, my little one that really sticks with me is Apple. If we flash back to 2012, this is Apple, iPhone's going crazy. They're just cranking out products like nobody's business. They were the it company. But then, at the time, they were selling on a quarterly basis like 45 million phones per quarter. And the stock was doing great, but then all of a sudden the estimates or the sales volume started petering off and basically almost flatlining or just, you know, tapering off a bit. And the analysts just freaked out. So they were just slamming the company. Like Apple stock, if you remember, was like almost in the 700s, and it just sort of dropped like almost in half. And the analysts were saying, you know what, the company's plateauing. They're only selling 45 million phones a quarter. They should be selling a lot more. They've lost their way. They can't innovate anymore. Other companies are going to take over. Samsung's going to dominate, blah, 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 blah. And it was just that reinforcing belief by a lot of the analysts and a lot of the mainstream media that this company is like literally going downhill. So where does context come in? Where does perspective come in? They're selling 45 million phones. 45 million. That's an insane, that's 1.5 times the population of Canada, where I live. So almost everybody in this country I live in here could get a phone, buy a phone, and then maybe another 15 million people on top of it could buy some more phones. But yet this was the analyst said this was bad, this is not good. This is horrible, company's in trouble. They've lost their way. The stock went down like almost by half. And it's just, again, the respect for numbers. 45 million, try sell 45 million of anything. If anybody could sell 45 million of anything, that's pretty damn good from my perspective. And it tells me that the company's alive. It's not going away. The company's, Apple's cash balances were over 100 billion. They had 100 billion in the bank with no debt. And they're selling 45 million phones, and they're selling all this other stuff too. Their Mac sales were going up. Everything, it was going great. But the analysts were hung up on the 45 million. They wanted more. And so the stock tanked. And at the time, I'm looking at this company. I'm going, this company is creating incredible returns on invested capital. It's selling 45 million phones, which is, to me, a hell of a lot of phones. Companies would kill to sell that kind of volume. No debt. tons of cash on the balance sheet, stocks at half price. So I bought it. I started buying. While everybody was selling this stuff, I was out there buying this stuff. Because again, context, appreciation, respect for the numbers. This is a great business. Why do we invest? We invest in stocks because we want to invest in great companies. This is a great company at the time. At the time, I'm going, this is one of the great companies on the planet. Why? And it's selling for half price. Why? And they're selling, and it's not like nobody's stopping buying phones. People are buying 45 million a quarter. It's fascinating. So, context, perspective. We need to, and lots of times when the analysts are looking at these companies and evaluating these companies, you have to have the understanding of perspective, of context. For understand the value, the quantity, and have a reverence for the quantity of these numbers. They're staggering, they're earth-shattering, and they are companies that can do this are in the long term going to be more valuable companies that if they can sustain this. So it's ironic because at the time, this was 2012, they were selling 45 million phones a quarter. Guess what they're selling now? They're selling on average 75 to 80 million phones a quarter. And guess what? The new iPhone 8 is out, the iPhone 10 is coming, and all of a sudden there's all kinds of little rumblings by the analysts saying, you know what, they may not, I don't know if they'll be able to sell that many. So instead of 80 million the next quarter, they might sell 77 million. And all of a sudden now you're starting to see sort of that negative vibe now coming back into the stock. Oh boy, the iPhone 10 is not going to be as popular. The iPhone 8 is pretty much like the iPhone 7. So who the hell is going to buy it? Well, they're selling 75 million phones. There's 2 Canadas now almost. They're selling 2 Canadas worth of phones now. And the analysts are going to find a way to say that's not good enough. And that's the nature, and that's what I say, when you're consuming information, when you're reading analyst reports, you have a better appreciation for the number and the value and the profitability and the quantity and the sales volume than what the analysts are. They're just looking at the number, and if it's not this number, then it's garbage. As an investor, you have that advantage of context, of perspective. You can go, 78 million phones is pretty damn good. Are they selling them profitably? Yes, they are. What's their strength of their balance sheet? Wow, they have hardly any debt. Well, now Apple does have a lot more debt now compared to what back in 2012. But they got $250 billion now in cash in the bank. I'm not saying go out and buy Apple stock right now, but I'm saying as you're thinking through your process of evaluating a company, perspective is a key element to bring into your analysis. Because, as I said, the smart money people aren't going to bring it to it, and they're not going to tell you about it, but you know it, you can use it to your advantage. Give me another example, just showing the power of numbers. Disney, in their last quarterly report, they said that their stock, their outlook for the upcoming fiscal year was that their profitability, their profit level was going to be the same as the profit last year. And the stock got killed. It was in the 110s. It went down into like the mid 90s. Everybody was like, Balint was like, Disney, they're in big trouble. ESPN's coming. People are like cutting the cord. They're in big trouble. They're going out of business. So their profitability is going to go down. So they're saying, they're going to make the same profit as last year. So okay, they're going to make the same profit as last year. So what did they make last year? So I went to see what they did. And last year, their profit, their net, their net income was $9.3 billion. They made $9.3 billion. A year ago, they had 9.3 less intangible wealth created than they do now. And so they're saying they're going to make another $9.3 billion, which is, again, an insane amount of money. But from an analyst perspective and a Bay Street, Wall Street perspective, not good enough. 9.3 billion is just, sorry, that just doesn't cut it. 9.3 billion of additional wealth that is being created for shareholders is not good enough. So if you apply that logic, then the company is pretty much garbage. But I don't know, when I'm looking at a business, if you're consistently generating $9.3 billion in profit, $9.3 billion more in your pocket than you had, more than you had the previous year, it's pretty good. That's pretty good. That's a pretty good company. You know, I obviously want to dig a little bit more into what the business is and all that stuff, but I'm going, yeah, like how is that a bad thing? But you wouldn't know it by the stock price. So as investors, again, if you have this perspective and you have this respect for the dollar, for the value of money and the importance of it, you can go and say, you know what, 9.3 billion is quite a hell of a lot. I may want to take a look at this company. You guys are saying it's a piece of garbage. Well, maybe I may want to take the other side of that trade, because I don't think I'm going to, you know, a $9.3 billion company that's generating $9.3 billion in profits is probably not going to go out of business anytime soon. It's probably a pretty low risk investment to make. Whether it's going to realize incremental value tomorrow, I don't know, but I think I could sleep well at night knowing that I have my money invested in an organization that has demonstrated a capability of creating tangible wealth for their shareholders and is selling products and services that people want and are making investment decisions into ideas and services that they think people are going to want in the future, and has assets that they know are going to generate incremental value for a long period of time. So if I have that perspective and that reverence and that appreciation for that dollar amount, I'm probably going to be putting myself in a better position to probably make some cash off of it and benefit from that and being associated with that in the long run than just by looking purely at a spreadsheet and at a comparable. And again, it comes down to perspective, come down to respect the value of money. If you can respect the value of money, respect the value of the dollar and the context and the perspective that is being looked at and evaluated, you're going to help yourself, you're going to identify much more interesting, much more potentially lucrative investment opportunities. And this is a skill, and this is that advantage that you and I have. But the people that are working on Wall Street, and the people who are working on Bay Street, and the people who are working on CNBC or whatever, they don't have that advantage. They just can't, because their world is very quarter to quarter to quarter. Performance, performance, performance. They're held, their compensation, and we can go into a lot of stuff. Their world is on quarter to quarter. Your world and my world is years. We have time. That's another advantage we have on ourselves, is we invest in quality assets over time. Probabilities are those assets are going to be worth more than when we bought them. Probability. It doesn't work every time, but the probabilities are more in our favor. So I just want to share with you. It's just something that's really, it's a concept that I see a lot. And I want to leave you actually with a definition. I found this really great. I don't know who the hell made this definition, but to me, it really sums up how we need to look at investing. And instead of looking at these dollars, like black and white kind of things, investing is very much, it's all about educated guesses. And this is a definition I found that's really great. So investing is, quote, it's about making probabilistic decisions with imperfect information about the unknowable future. How we think about that future, whether our assumptions, extrapolations, and projections are remotely accurate, is going to determine our investment success, or it's going to determine our investment failure. Ultimately, we're making decisions. Investing is about making decisions with imperfect information. And a lot of times we are living in a world where we have so much information, so much data that's just flying in and out. We lose perspective, we lose context. And a lot of times it's just not there. And a lot of times it's just garbage, but sometimes we just have to make a decision. And that's what investing is. And that's what I kind of teach people, is just learning how to make educated guesses. Because chances are, if you make more educated and more informed guesses with a respect for the information that's in front of you, with the context, respect of the value of the dollar that's in front of you, the value of money, chances are you're going to make more successful investment decisions than bad investment decisions. And so perspective to me is a competency that we need to develop. And I try to teach people to develop that, along with just being more engaged, being more educated about the mechanics and behavioral aspects of investing. The empowerment side, just the constant practice, but just perspective. When you're looking at these opportunities that are in front of you, look at them with perspective. Understand and appreciate the value of the numbers that are coming into you and the perspective and the context that are around it too. So I just want to share. It's something that's really important to me, and it's something that I've really taken to a lot of consideration in how I make my investment decisions. because it allows me to just frame them on a basis of reality and just make a reasonable guess on terms of whether that investment is going to pan out or not. So it's something I want to share with you. One announcement before I head out is I'm actually, if people have noticed who has subscribed to my email, my weekly email, I send out a weekly email every Wednesday morning about various things, all my blog posts and whatever that I'm doing on my website, but I also share some interesting articles and videos and perspectives from other people out there who I think know way more about investing than I do, and actually I use them and I leverage their thoughts and ideas and try to frame them into my own investment decisions. So if you subscribe, go to my website, sageinvestors.ca. There's a little subscription there. Just drop your email name, and every Wednesday morning before you wake up, it'll be in your inbox. One of the things I've been doing is about a month ago, I just set up a Facebook page because people said you need to be on Facebook. So I said, okay, I'll put it on Facebook and I'll post all my blogs and stuff like that. So that's another way you can get some real-time access to what I'm doing. So just go to Sage Investors on Facebook. There I am, you'll find it. But one of the big reasons I kind of set it up too was because of this Facebook Live feature where you can just go on video and just talk about anything you want. And I thought it'd be a really cool way to talk about what's going on in the market, kind of give some more real-time incentive about what's going on in the market. But the other thing I thought about too, and I've always wanted to do, is I just want to engage more people about investing. It's just be a really cool way to use Facebook Live to engage people who have questions about investing or kind of stuck about something and just want to kind of bounce an idea off and kind of get a different take that might help them, give them some more perspective in how they make the investment decisions. So I've just started basically what I said, you know what, every Wednesday night between 8 p.m. and 9 p.m. Eastern Standard Time, I'm going to just go on there on Facebook Live for an hour, and I'm just going to be there and talking about investing. And I'm basically going to be there to answer questions. If you have questions about investing, you have questions about something about stocks, terminology, some kind of a question about in terms of how to go about evaluating them, or just a decision you're making. You're like, oh my God, I'm thinking about buying Target stock. How do we go about doing that? And we'll walk through it. I'll walk you through some ideas and some approaches to just kind of figure out answering those questions. So I'm on there every Wednesday between 8 p.m. and 9 p.m. Just jump on through my Facebook page, Sage Investors, and catch away. If you can't make it, all the replays are also going to be on the page too. If you have a question but you just can't get on board to ask me those questions in real time, just drop a comment on my Facebook page, and maybe I'll catch it. If I see it, I'll catch it. I'll try to answer it right there, or I'll try to answer it on the following week. So every Wednesday between 8 p.m. and 9 p.m. Stock Talk Live. That's what I called it. It's like, okay, I'm kind of trying to come up with a name. Gee, I call this my podcast Stock Talk, so I'm gonna do it live, so Stock Talk Live. So let's just do it on Facebook Live every Wednesday. I've been doing it for a couple of weeks now, and it's been kind of cool in just talking for like an hour of investing, which I love to do. I could probably talk for more, but I'm really into this stuff. I'm really passionate about this stuff, and so I'm here just kind of there I'm just there. So as you're cruising around Facebook, looking at some pretty pictures, looking at pictures of food, looking at pictures of trees, looking at memes, reading stuff about Trump, take a few seconds, pop on over to my Facebook page and talk some investing. All right, so that's every Wednesday, 8 p.m. to 9 p.m. on Facebook, Sage Investors. Catch it, should be cool. It's cool. That's all I got for you this week. Thank you for listening. If you want to listen to more of my podcasts, I got a whole whack of them. They're on iTunes. We're on iTunes. Do a search for Sage Investors. Feel free to subscribe, leave a review, leave a comment review if you find this stuff interesting. You can go to my website also, sageinvestors.ca. You can learn more about my blogs, my posts, videos, and also more information about my coaching services. I teach, as I said, I teach people, I teach investing, I teach a course on investing in stocks, and I also have a course on investing in ETFs. And so if you're interested and want to learn more about it, just jump on my website. I'm on Twitter. My handle is @SageInvestors. Anything I see out there in the market, what's going on in the market, and I commented on real time. Any investment decisions that I make, I tweet them out there in real time too, because it's just part of my transparency, part of my being open and transparent about the work that I do. It's one thing for me to teach people how to invest, it's another thing to apply what I do. And so that's where Twitter, I think, is really cool in that sense. Gives you that perspective, that real-time kind of hit on terms of what's going on in the markets. So thank you very much for listening. My name again is Amin Reina of Sage Investors. Thank you for listening, and we'll catch you again another time. Take care, bye-bye.